Yeah. Well, their Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're
Yeah.
going to be reflecting investors' perceptions because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. When you have something that has a hyper growth on ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800? I mean, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being.
Over the past 6 weeks, the cryptocurrency market has challenged investors in a manner that appears both familiar and notably detached from reality. Prices have declined further despite the resilience of equities. Leverage has significantly diminished. Nevertheless, none of the conventional explanations adequately account for the phenomena we have observed. That is precisely the point at which Tom Lee intervenes. Lee has dedicated decades to the analysis of market structure, liquidity cycles, and the psychology underlying price discovery. And in this discussion, he contends that the recent actions of cryptocurrency are not attributable to any concealed existential threat. Instead, he highlights a more fundamental phenomenon, something occurring beneath the surface that the market has not yet fully acknowledged. In his most recent interview, Tom explains that the disparity between the S&P 500 and cryptocurrencies is not attributable to fundamentals, nor is it related to quantum risk, but may merely be the consequence of a single severe liquidation event that eliminated an entire cohort of retail participants. However, more importantly, he elucidates the reasons why this form of selling ultimately ceases and why we might be nearer to that juncture than most individuals perceive. As you listen, consider this. If the most recent vendor has already completed a sale, what implications does this have for the subsequent phase of this market? And what are the subsequent implications following an enforced reset of leverage? Remain engaged, as later in the video, Tom presents a comprehensive analysis of tokenization, Ethereum's supercycle, and the institutional flows that are discretely transforming the landscape. Before we proceed further, please ensure you click the like icon, subscribe, and share your opinion in the comments regarding whether you believe this recent decline is due to leverage or structural factors.
Yes, I'd be glad to. For the listeners, in 1971 was when the U.S. formally withdrew from the gold standard, meaning the dollar was no longer redeemable for gold. And from that point forward, the U.S. and other countries, not every country went off the gold standard, basically said that from this point forward, a dollar is only exchangeable for another dollar. Okay, so the dollar became essentially synthetic relative to gold. And in 1971, many investors correctly bought gold because they said, well, that's the original store value. However, the second reality is that we had to suddenly protect the dollar to make sure it was going to be the world's reserve currency, because if that was no longer exchangeable for gold, then a country that was still in the gold standard could become the new reserve currency. So what happened? Wall Street built a bunch of new products to make sure that the dollar became the accepted standard. And over that ensuing 10-year period, it was money market funds were created, CDs, futures, ETFs, and it was successful because the dollar remained the global reserve currency. And today, it's now 80% of all financial trading pairs. In 2025, there is a similar evolution taking place, and it really started with stablecoins, which is that the dollar, which was already now synthetic, became tokenized on the blockchain. So now the dollar is now digitally represented, and that's what a stablecoin is, because it's backed by treasuries but it's still basically just a digital dollar. That is going to be creating the roadmap for a lot of other assets to become digital, tokenized on a blockchain. And it's a big deal. We know that in crypto, for instance, the projects that have actually emerged from as native blockchain products have actually been better mousetraps. And that's something that is driving and sending Wall Street to build. The first of these has been the stablecoin and Tether. And Tether, as an entity now, it's valued, and they're raising at what is reported to be $500 billion. That would make it the second most valuable bank in the world. And even if it ends up being raising at 400 billion or 300, whatever that number is, they're still the second most valuable bank in the world after JP Morgan, which is 869 billion. So a company that has today maybe 300 full-time equivalent employees is almost as valuable as a bank like JP Morgan has 313,000 employees. So there's a lot happening. There's a lot of benefits that come from tokenization, and I think that that's the big unlock that's coming. But yeah, I agree with you, Chris. It is when something becomes native digital, it works really well. I mean, there's many examples. I mean, for instance, crypto trading 24/7 is an example, but look at how we do all communications. It is all native digital now. I mean, emails are digital, or, messaging. And in fact, over the last 10 years, I think it's a low estimate to say that at least 50% of all GDP growth in the last 10 years is native digital. It's probably now close to 60%. In the next 10 years, it's probably going to be 70%. So increasingly, almost all innovation and growth is native digital, and yet we're using geographically defined currencies, and we're trading instruments only 5 days a week with specific market hours, even though during those market hours, 99% of all the trading is already electronic anyways. I think one of the challenges as we tokenize is, of course, going to be making sure there's still the same liquidity that's available, because we know one of the glitches in crypto is liquidity is not universal. And so we do want to make sure prices are correctly reflecting a deep and full market whenever we see a price posted. But that's, of course, software. I mean, someone can define prices correct or put limits on price change.
What Tom is describing is not merely a moment of vulnerability within the cryptocurrency sector. It is the customary pattern observed at the conclusion of each deleveraging cycle. Retail experiences the initial impact. Over-leveraged speculators face the risk of significant losses. Liquidity temporarily diminishes, causing prices to exhibit seemingly irrational behavior until the underlying exhaustion is ultimately resolved. And this precisely underscores the importance of the subsequent segment of this discussion. Although headlines have primarily highlighted price declines, Tom contends that the true narrative of 2025 is unrelated to short-term fluctuations, and instead pertains to a fundamental structural transformation akin to the 1971 cessation of the gold standard by the United States. This statement is not an exaggeration. Tom contends that we are observing the emergence of a novel monetary structure, one where the dollar is not merely synthetic in relation to gold, but entirely tokenized, accessible around the clock, and capable of integration into every tier of the global financial system. And while the shift from gold-backed currency to synthetic dollars spurred a significant surge in financial innovation, Tom contends that the tokenization of dollars on blockchain platforms will be exponentially greater. In the following segment, Tom will analyze the precise reasons behind the acceleration of tokenization, explain why Ethereum is positioned at the forefront of this transformation, and discuss how the forthcoming institutional phase may differ significantly from the retail-driven cycles experienced over the past decade. His clarification synthesizes all elements cohesively: the recent market volatility, the depletion of leverage, and the ongoing significant technological transition.
Yeah. Well, Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're
Yeah.
going to be reflecting investors' perceptions, because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. Whenever when you have something that has a hyper growth on ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800, I mean, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors. And that's why there's hyper volatility. It's one reason why BitMine ended up engaging Tom DeMark as a strategic advisor, because he is the king of sort of price discovery. He is the father of systematic timing. And in our conversations, when he looks at Ethereum, he sees what looks like engineered or systematic liquidation taking place. So there is someone that is in crypto, we know it's market makers play a big role, but there is someone that is probably capital constrained and is therefore bleeding or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level, because then that is creating what he calls a buy setup. A bottom in prices for him is when the last seller has sold, so that a stock or crypto no longer falls on bad news. I mean, that's what he thinks makes a bottom. So it would, I think, be a better situation to see crypto prices bleed lower to 2,500. But it could reverse at any time, because markets don't have to do what ends up being an ideal scenario. Someone wanted to say, why did crypto diverge from equities?
Yeah.
That's, I think, a big role, because they're in the past 6 weeks, nothing has actually fundamentally explained why crypto should be underperforming risk assets. Because the S&P, of course, has had a drawdown, but the S&P continued to rise for another 20 days. The S&P didn't peak till the 29th. So that divergence has to reflect either a change in how market function in crypto, or was there an existential new risk? I mean, the only new existential risk would be like if quantum innovations came along, but there hasn't been that. So
you think it's existential or just idiosyncratic? I mean, nothing seems existential here to me.
Well, I mean, Chris, the one thing that I would say that maybe isn't reflected in price is the number of account holders that got wiped out on October 10th. And I think that's, and we may not even hear from them because, they've been liquidated. I think to me, that's probably, now that could be someone's simply saying there was just too much leverage. That's why leverage is hitting crypto harder. I mean, that's a possible explanation. But to me, again, especially working with DeMark team, I think that there is something that is causing a lot continued leaking, but we're close to the end of that leaking.
Yeah.
You're spot on, Chris. Like when someone says, what is Bitcoin? I think everyone really accepts it as it's a store of value, a really good way to store value. And that's accepted today. In fact, someone might say that's like a Lindy effect, that people believe that. When we first started writing about Bitcoin in 2017, and digital gold was one way to sort of argue Bitcoin's value, it was not accepted because many people said, well, come on, I mean, it's just code. I mean, how can code store value? Or why can't there be 100 Bitcoins? Or look, I could create a new Bitcoin tomorrow, or I could fork Bitcoin and create a new Bitcoin, or I can't buy. I remember one client saying they couldn't buy a bottle of water with Bitcoin, so how could it even be valuable? So, but of course, all those arguments fell away. And now we have digital gold, Bitcoin, store of value. Even as gold gets tokenized, which I think will compete with Bitcoin to an extent, you still have Bitcoin, which is a really good way to store and transfer value. But Wall Street is also understanding there are a lot of virtues to a blockchain. And it's the ability to not only store value, but to store information and to actually transact and conduct and actually re-architect almost everything that Wall Street does. But they need a smart contract platform. And so that's where all these other L1s start to become a lot more important to Wall Street's future. Because if the big banks, the blue chips, build stable coins, and they're going to tokenize stocks and let stocks trade 24/7, and then innovate that too, which I discussed at the Cantor, which is like things like factor.
As Tom articulates here, the turbulence we have observed does not indicate a collapse of the cryptocurrency market. It indicates a shift in the market from retail dominance to institutional influence. The transformation he depicts does not refer to Ethereum exceeding Bitcoin's market capitalization. It is the point at which substantial, liquid, long-term market participants commence substituting short-term speculative movements. And when that transition occurs, core principles regain their significance. Utility assumes importance once more, and platforms capable of supporting tokenized assets, smart contracts, and continuous global liquidity quickly establish themselves as the foundation of all future developments. Tom's perspective on Ethereum aligns with that reasoning. The current volatility does not indicate a deterioration in fundamentals. It is merely the market adjusting the valuation of the future amidst a period of compelled liquidation. And upon enlarging the view, the timeline aligns with each preceding adoption cycle. Bitcoin required an entire decade before institutional interest was genuinely established. Ethereum is now surpassing that same threshold, but with a significantly more diverse range of use cases, a worldwide community of developers, and a role that extends well beyond serving as digital gold. Tom's fundamental argument is straightforward. As Wall Street advances further into tokenized assets, including equities, treasuries, corporate bonds, and structured products, there will be a need for a neutral, secure, and continuously accessible smart contract platform. And Ethereum remains the largest, most extensively tested, and most broadly supported option. When considering the resurgence of institutional flows, the acceleration of tokenization, and the historical tendency for market bottoms to occur following the capitulation of the final coerced seller, the scenario Tom describes appears significantly more constructive than the recent week's price movements might indicate. Therefore, the fundamental question is this: if we are observing the concluding stage of structural selling and institutions are preparing for the forthcoming decade of digital finance, how will you position yourself for what lies ahead? Please share your perspective in the comments. Please like this video if this analysis assisted in clarifying Tom Lee's thesis, and be sure to subscribe for further comprehensive insights. Thank you for your attention, and I look forward to seeing you in the next installment.